Hi friends, in this video we are going to continue our discussion on the SEBI current affairs and we are going to move on to the month of September 2018. So this is going to be the part 1 of this particular video and this is going to be very important for the upcoming SEBI Grade A 2018 examination. So let's start with the first news item, which is SEBI changes total expense ratio of the mutual funds. So this total expense ratio has come so many times in the current affairs and I believe most of us are aware about this term now. And this total expense ratio, it means the fund cost divided by the assets of the fund. So this is a measure of the different costs which are being made out in the mutual fund, and there may be different kinds of costs like various kinds of fees which have to be paid, auditing expense or any redemption expense, etc. Now, SEBI in its board meeting on September 18, 2018. So this is important that SEBI recently conducted a board meeting in September 2018, and most of the items of this board meeting we have separately discussed in the different videos, and separate circulars also we have discussed based on these board meetings. So most of the items they are already covered, but still we are going to continue our discussion and we are going to revise all these news items in this particular video. So SEBI in its board meeting announced certain changes in the total expense ratio of the mutual funds, and these changes were made to ensure that there is transparency with regard to the appropriation of expenses by the fund house to this mutual fund, and to reduce the mis-selling and continuous churning of these mutual funds. The total expense ratio is a measure of total cost of a fund to the investor. So SEBI wants to make sure that the investor is more and more aware about what expenses are going to be charged to this particular scheme, and there should not be any kind of mis-selling or any kind of a move to make investor pay more under the garb of these particular expenses. Now, the changes which have been made, they relate to open-ended schemes also and the closed-ended and interval schemes also. Now, for the open-ended schemes, there has to be a separate set of expenses which are to be permitted for equity-oriented schemes and for other schemes. And this expenses is going to be dependent on the asset under management of that particular mutual fund. So if the assets under management are less than 500 crores for equity oriented schemes, this is going to be 2.25%, and for other it is going to be 2%. So this we have to remember that it is different for equity oriented and other than equity oriented, and it is based on slabs. So this is something which we have to remember. And as the assets under management they keep on increasing, this expense ratio it goes on decreasing. So this is what we have to make out of this particular document. Now for other schemes, for close-ended and interval schemes, this ratio shall be for equity-oriented schemes maximum of 1.25%, and for other than equity-oriented it will be maximum of 1%. And for index funds and ETFs it will be maximum of 1%. And for fund of funds it shall be maximum of twice the total expense ratio of the underlying funds which are making up this kind of a mutual fund. Now all these terms, close-ended, interval schemes, index funds, exchange traded funds or ETFs, and fund of funds, they have been separately discussed elaborately in one of our earlier videos in which we have discussed the important news items with regard to mutual funds. So we are not covering them in detail here, and you are advised to refer that particular video for detailed discussion on these schemes. Now also some other changes have been made, like all commissions and expenses have to be paid from this scheme only and not from any other route. They are not to be paid from the asset management company or the associate or the sponsor of the mutual fund or any other route. In a nutshell, we have to remember all the commission and expenses of the scheme will be paid from the scheme only. Further, the model of commission which is to be adopted by the mutual fund has to be a full trail model of commission. So full trail model of commission, it means that you do not have to pay any upfront commission, and all the commissions they are going to be paid when the investor it remains committed to the scheme of mutual fund. So for how long the investor remains committed, that is the period that is going to determine the commissions which are to be paid by the mutual fund. Further, the additional expenses permitted for penetration in B30 cities. Now, these are the cities in which we are trying to penetrate the mutual funds, and for the purpose of this penetration, we have allowed certain additional expenses to be permitted to the mutual funds so that they can meet their expenses for this penetration. And we have decided that this additional expense shall be based on the inflows from retail investors only, and it does not have to include the inflows from institutional investors. Further, the adequate disclosure of all the schemes returns category wise vis-a-vis its benchmark, it has to be made on the website of Association of Mutual Funds of India as well. So these are the different changes which have been made with regard to the mutual funds, and here we have just briefly discussed these changes. They have been discussed in detail in our separate video, so you guys are requested to cover that particular video for all the details of this particular discussion. Now next is SEBI's new KYC regulations for foreign portfolio investors. So these are also something which we have already covered as a part of a separate circular video. So we are not going to cover this much in detail here. So let's take a quick look at what this is about. So SEBI has relaxed the KYC norms and eligibility conditions for foreign portfolio investors. So SEBI has said that this beneficial ownership criteria which is to be used, it has to be restricted towards KYC only. So this criteria which is there in the prevention of money laundering rules, it should only apply for KYC, and for determining the eligibility of FPIs, this should not be done. So there has to be a separate set of norms for determining the conditions where NRIs, overseas citizens of India, and the resident Indians, they are constituents of FPIs. Further, the KYC review, it has to be done based on the risk categorization of foreign portfolio investors. So there are 3 categories of FPIs, and for category 2 and 3 FPIs which are coming from high risk jurisdictions, the review has to be done on an annual basis. So these were the major decisions which were taken by SEBI, that these rules have to be made applicable only for KYC and not for determining the eligibility. And it was also said that NRIs, OCIs, and resident Indians, they are allowed to be constituents of FPI if a single NRI, OCI, or a resident Indian, it holds less than 25% in that FPI. So this is about the changes which were made, and we have already discussed them as a part of a separate circular. So you are requested to cover that particular circular as well for better understanding of this news item. Now the next one is SEBI and RBI are closely monitoring the financial markets. So Reserve Bank has said that it is, along with SEBI, it is working towards closely monitoring the recent developments in financial markets, and it is ready to take any actions if the need facilitates. And this was said after there was a plunge in the share prices, and the domestic stock exchanges, they were on the downslide, and the RBI was worried about the forex outflows from the country, and SEBI was concerned with the volatility in the capital markets. So that's why they were both closely monitoring the financial markets. And moreover, the overseas investors, they have also started pulling out a massive amount of capital from the stock markets in India, and this is going to impact the volatility as well as the forex reserves of the country. So this is something which these two organizations, RBI and SEBI, they are worried about. So that's why they are in this process of monitoring the financial markets. Next is, will not let manipulators cash in on market volatility, SEBI. So again, SEBI is worried about the market volatility, and SEBI has said that it will not allow the manipulators to take advantage of this volatility in the stock market. Now, volatility in the stock market has recently been due to different global and domestic factors which have impacted the investor sentiment, and they include the concerns relating to trade war between US and China. While the domestic markets, they are witnessing a free fall due to sharp decline in the rupee value. So the exchange rate of the India's currency, it is also on the downslide, and that's why this domestic markets have also witnessed a free fall. So these are the different reasons why the market is on the downslide, and SEBI is worried about this market volatility. Next is SEBI to levy rupees 1 lakh per exchange on turnover from agri commodity derivatives. Now SEBI and stock exchanges, they are taking various steps to promote agricultural commodity derivative segment in the country. And the reason is that this kind of a segment, it involves the participation of farmers as well as farmer producer organizations. So in order to promote these, they are taking certain actions. So recently SEBI has announced that it is going to charge only a nominal regulatory fee of rupees 1 lakh per exchange. So only a nominal fee of rupees 1 lakh per exchange, it is going to be levied on the turnover which arises from the agricultural commodity derivatives, instead of levying the charges based on the turnover. So instead of seeing what is the turnover of that exchange, if the turnover is higher, we are going to levy a higher charge. So instead of looking at this aspect, SEBI has put in a flat 1 lakh per exchange regulatory fee for the turnover from agricultural commodity derivatives. SEBI has said that the exchanges which are dealing in these agricultural commodity derivatives, they have to create a separate fund. And such regulatory fee which has been foregone by SEBI, it has to be deposited in this particular fund, and it will be utilized exclusively for the benefit of farmers and FPOs in the agri derivatives market. So this is what the SEBI has announced, that it is going to promote the agri commodity derivatives market, and that's why it is going to charge only 1 lakh per exchange. Now if you try to understand this concept of farmers producer organization, this is derived from the concept of producer organizations. Now producer organization is a legal entity, so it is a legal entity which is formed by primary producers. Now these primary producers may be farmers, they may be milk producers, they may be fishermen, they may be rural artisans or craftsmen. So they can be different persons who are primary producers. And a producer organization can be a producer company, or it can be a cooperative society. So it can be in the form of a company, or it can be in the form of a society, or any other form, but the objective is to share the benefits among the members. So different farmers, they may come together for the purpose of pooling their resources, and any benefits which arise, they will be distributed among the farmers. So farmer producer organization is one type of a producer organization in which the members are the farmers, and they have come together to make certain gains. Now if we try to understand the meaning of agro commodity derivatives, then this is derived from the meaning of the word derivatives itself, and derivative is a kind of a contract between two or more parties, and the value of this contract is based on some underlying asset. And where these underlying asset is an agro commodity, the derivatives become agro commodity derivatives. So for example, the two persons may enter into an agreement that one person will sell wheat to another person at 31st December at a rate of rupees 100 per kg. So this is a kind of a derivative contract whose value is determined on the price of the wheat, which is the agro commodity. So this becomes the agro commodity derivative. Now if you are a farmer, there is a possibility that your produce may come down drastically at the time of harvest. So farmer is worried that at the time of harvest, the price of the produce, it may decline. So what the farmer can do, it can enter into similar contracts like selling wheat in future. So that is something which is going to make the farmer secure about the price which he is going to get for the sale of wheat. So the farmer can effectively lock in the price at which he wishes to sell the produce at a future time. So this is something which is why the farmers, they can take advantage of this agri commodity derivatives market. Next is BSE NSE gets SEBI clearance to launch commodity derivatives. So again, this one also is linked to the commodity derivative segment, and the Bombay Stock Exchange and the National Stock Exchange, they have got the approval from SEBI, and they are going to launch the commodity derivative segment with effect from 1st of October 2018. Now, SEBI December 2017, SEBI announced that from October 2018, the country would have a unified exchange regime. Now, this is very important, that this unified exchange regime, it would involve that stock exchanges would be allowed to offer trading in commodity derivatives. So you do not need to establish a separate commodity derivative exchange. The stock exchanges themselves will be allowed the trading in commodity derivatives. So for this particular purpose in mind, SEBI came out with this announcement, and the stock exchanges, they plan to launch the derivative trading in the non-agricultural commodities in the initial phase, followed by the agricultural commodities. Next is commodity exchange derivative norms to apply to bourses or exchanges which are entering business. Now this is again in reference to the recent approval given to BSE and NSE with regard to launching of the commodity derivatives segment. Now they were worried what would be the rules they have to follow with regard to the commodity derivative segment, and in this respect SEBI has given this clarification that all the norms which are issued for commodity derivative exchanges, they will also be applicable for the commodity derivative segment of the recognized exchanges and clearing corporations. So there will be no separate set of norms for BSE and NSE with regard to this new segment. The norms which are there in place for the commodity derivative exchange, they are going to be made applicable to the commodity derivative segment also. Now, as per the amendments in the relevant regulations, there would be no separate category of commodity derivative exchanges from 1st of October 2018, and this has been announced by the SEBI, which is the regulator of the stock market. So SEBI has announced that these are going to be the final norms, and in the future we are not going to deal with the commodity derivatives exchanges. We are going to only have this particular segment of commodity derivative trading in the stock markets. Now if we talk about the unified exchange regime, then this means that the stock exchanges, they need not to set up separate entities to offer commodity trading. So if BSE and NSE, they have to offer commodity trading, they can offer it themselves only. They do not have to set up any other particular entity. Now these kinds of universal exchanges, they are going to help in achieving integration of trading in the commodity derivative market with the other segments of securities market at exchange level. So this is going to kind of bring integration in the trading of the securities. So for example, if there is any company whose commodities are going to be traded in the this market unified exchange, then the share of the company can also be traded on that particular exchange, and it is going to better help the investors in taking out the different decisions. So this is going to help in rationalizing this entire value chain, and this is going to bring benefits in the terms of price discovery, cost effectiveness, user friendly, risk management system, and wider market participation. So this kind of a system is already there with the stock exchanges, and now they have to come up with a separate segment. They can easily come out with that, and the infrastructure can be pooled. So that's why it is going to result in efficiency gains. Now the next is LIC may seek SEBI exemption for open offer to IDBI shareholders. So LIC might seek an exemption from SEBI from making an open offer to the minority shareholders of the IDBI bank, and in this particular bank the LIC is set to buy a 51% stake. Now why this need for exemption it was there? Now according to the SEBI's takeover code, an acquisition of more than 25% in a listed entity is termed as a control, and it requires an open offer. So if any entity is acquiring more than 25% in another listed entity, it would mean that it is a control, and it would require an open offer to be made. And under this arrangement, the acquiring company must make an offer to the existing shareholders that if they want to sell out their shares to them, they can sell out their shares. So the objective is to provide the shareholders an exit option. So the shareholders of the company which is being acquired, they have an exit option that now the company is going to be changed. The new management is going to be there. If they don't feel like being in the company, they can sell out their shares to the new company, to the acquirer company, and they can move out of the company. So this is basically an exit option for the shareholders. So this is how the things are going to be like as per the SEBI substantial acquisition of shares and takeover regulations 2011. So as per the regulations, if an acquiring company is acquiring more than 25% stake in the target company, then the acquiring company has to make an open offer to the existing shareholders of the target company that if they want an exit option, if they want to sell their shares to the acquiring company, they can do so. Next is company can announce price band 2 days before IPO SEBI. So the SEBI has recently relaxed its IPO norms, and it has allowed the companies to announce the price band 2 days before an offering. Now price band is a very important term with regard to issue of shares. Now presently the price band has to be announced 5 working days before the initial share sale opens for subscription. Now the SEBI has also said that financial disclosures which are required to be made, they are also going to be made simpler, and they are going to be provided for 3 years only. Earlier they were to be provided for 5 years. So this is about SEBI introducing some norms with regard to public issue of securities. So now price band can be announced 2 days before, and the financial disclosures will only have to be made for 3 years. So these kind of a simpler disclosure norms, they are going to promote the firms to garner money through capital market route. So this is going to promote more and more firms to come to the capital market and raise money. So if you try to understand this concept of price band, now this price band is a price floor and a cap between which a seller will let the buyers to bid for the securities. So if let's say company XYZ is going to issue its shares to the public, and as a part of the IPO process, the company XYZ's investment bank, it sets a price band in the shares of rupees 45 to rupees 50 per share. So all the bids which are to be made by the investors for acquiring the shares of the company XYZ, they are to be made within this price range. and this is going to be the minimum amount, that is rupees 45, and rupees 50 is going to be the maximum amount. The final price is going to be determined by the market forces, that is how much the subscriptions the company receives and how much the shares the company has to allot. So this is going to help determine the final price, and this whole mechanism, this whole process is technically termed as book building process. So price band is a very important term associated with the concept of book building of securities. Now let's discuss some of the MCQs on the topic we have just covered. So first question is, SEBI in its board meeting on September 18, 2018 announced certain changes with regard to mutual funds. Which of the following is correct in this regard? All commission and expenses shall necessarily be paid from the scheme only. Mutual fund industry must adopt the upfront model of commission in all the schemes, both of the above or none of the above. So friends, we have covered that the mutual fund industry have to pay the commission using the full trail model and not the upfront model. So here the statement number 2 is going to be the incorrect one, but the first statement is going to be correct one, because these expenses are to be necessarily paid from the scheme only. So the answer would be option number A. Next question. According to SEBI's recent regulations, KYC review should be done based on the risk categorization of FPIs. For category 2 and 3 foreign portfolio investors from high risk jurisdictions, the review should be done. Options are monthly, quarterly, half yearly or annually. So this we have covered that for these categories of FPIs, the review has to be done annually. So the correct answer is going to be option number D. Now let's move to the next question. Fees to be levied by SEBI on exchanges on turnover arising from agricultural commodity derivatives is. Options are rupees 1 lakh per exchange, rupees 5 lakh per exchange, 2% of the turnover of exchange, or none of the above. So friends, this we have covered that the fees to be imposed by SEBI with regard to agricultural commodity derivatives turnover is going to be rupees 1 lakh per exchange. So the correct answer will be option number A. Next question. According to SEBI's takeover code, an acquisition of more than -% in a listed company is termed as a control and requires an open offer. Options are 15%, 25%, 35% or 50%. So this we have covered that when an acquisition of more than 25% is made, the company has to make an open offer to the minority shareholders. So the correct answer is going to be option number B. So friends, these are the answers. So friends, this was all about our discussion with regard to current affairs of SEBI for the month of September 2018, and this was the first part of this particular video, and we will soon be posting the second video. Thank you.